Austin, I'm going to start with you. I'm curious what you think if you actually look at this infrastructure bill, and there's a debate about how much of it is it actually infrastructure and how much is it everything else, what it actually means to employment long term.
I think it's probably, I'm a little confused by this insistence that the word infrastructure should only mean roads and bridges. To me, it clearly doesn't. And when Biden was running, he clearly outlined that he wanted to build structures, public structures to help society and energy, build schools, build hospitals, a bunch of those things. I think in the short to medium run, it's probably a lot of jobs in the construction of those things. Over the longer run, I think you raise an interesting point. There's the limits on job creation are about the population. They're not about the business cycle. So, I mean, it's worth thinking, it's not expanding the population. So it's more changing the sector that people are working in.
Doug, I assume that you are a little more reticent than Austin to embrace this.
Yeah, I have some real concerns. The target here is the longer-term trend pace of economic growth. And if you look at the composition, if you were to raise the taxes they're raising, the corporate rate, global minimum tax, book income tax, and spend that really, really carefully on core R&D, core infrastructure, you might break even, but I doubt it. If you water it down with the sort of social programs they've got in there, $400 billion expansion of Medicaid, Medicare, and a whole bunch of other things, and then toss in this Protecting Right to Organize PRO Act, which is an extraordinarily anti-growth provision, on balance, this is bad for economic growth, bad for the economy.
Explain that last piece. Why did you say that?
So the PRO Act would preempt right-to-work laws in 27 states. It would change the classification of workers and independent contractors, much like California has with its ABC legislation. It would embrace the joint employer standard that would allow essentially the end of the franchise model in the United States. So it would get rid of the prohibition on secondary boycotts and lead to a lot of very disruption in the flow of goods and services. So there's none of that is about creating jobs or creating greater productivity. So I have real concerns about the economic policy that's in this proposal.
Hey, Sarah, as you try to math this out, but also try to think about the probabilities of what actually gets passed, how do you see it? And how do you think that market players should see it?
I mean, the key for this bill and its impact on the economy is how much are we spending versus how much in taxes are we increasing to pay for that spending. We do think this could increase GDP by about 0.5 point in 2022. But from a market impact, after it was announced, we had a sell on the news. And basically, growth stocks went up, and the stocks that would have been beneficiaries of this bill actually underperformed. We think that was for 4 key reasons. One is questions about those tax increases and the hit to earnings that we'll get from those. Second is the legislative issues. How easy is it going to be to pass this bill, or what bill will pass? Thirdly, also is COVID cases. They've been increasing globally. That could cause a short-term air pocket for the economy. And finally is that recent run that we've seen in cyclicals versus growth stocks. Cyclicals have been outperforming growth stocks for about 6 months, and growth stocks are looking more attractive. So on a valuation basis, people have been buying growth stocks.
Shepard Smith here. Thanks for watching CNBC on YouTube.